We'll be going over IRS Form 15620, Section 83B election. This is a pretty new tax form issued by the IRS in April of 2025 that covers what's known as a Section 83B election. Prior to this form being issued, the taxpayer who wanted to make an 83B election in a certain tax year would have to create a statement as defined in the Treasury regulations, specifically to make this election. So before we get into this form, we should talk about what a Section 83B election is. So Section 83B of the Internal Revenue Code talks about the transfer of money or property in exchange for performance of services. And so generally speaking, when it comes to non-vested property, you can make, you are generally not taxed on any unvested amounts, typically with, for example, stock grants. You would not be taxed on any amounts that you were granted of, say, stock options or stocks or incentive stock units, ISUs, or restricted stock units, RSUs. You would not be taxed on those until they're actually vested. So a lot of people might work for a company where their part of their compensation package includes stock grants or RSUs, and they kind of don't know how to treat that particular grant. There's a couple ways that you can do it. So first, you can simply recognize the income when those shares or those options vest. So a typical vesting period might be 3 years. So let's imagine that you were granted 1,000 shares of stock options, but the first of those is not going to vest until 3 years from now. You can simply just keep track of it, and then you would pay the taxes on that when they actually vest in 3 years. However, you can also choose to make the current, to recognize income at the current value of those shares or options in today's dollars. And this might make sense in the case that you have no uncertainty that you will be with that company in 3 years. A lot of stock grants will come with the condition that if you're terminated for the employer's convenience, that those shares automatically vest, you get to walk away with them. So as long as you don't leave of your own accord, that's probably the biggest risk about making an 83B election. You're making a tax payment today based on money or the value of property that you don't currently have the rights to. So you're betting on the fact that you're not going to walk away from those rights. You're also betting that in 3 years, the value of those stocks, those options are going to be much higher than they are today. And it is in your best interest to go ahead and pay a smaller amount of tax in today's dollars than it would be to watch those shares appreciate over the next 3 years and pay taxes on them down the road. So making this Section 83B election, you used to have to dig up some sort of arcane Treasury regulations, Treasury regulation section 183 basically has to do with the Code of Federal, what's actually included in gross income. So that's basically what we would be deriving a statement, and then you would be sending that statement to the IRS with your tax return, and then you would have to put in key information. And so the IRS came up with this form in 2025 to make it simpler for people to communicate exactly what they're recognizing as income in the current year. So, a couple of things before we actually get into this form. Uh, Most common would be stock options, grants, things of that nature, but really it has to do with any type of property that you've received in the form of compensation where you don't have vested rights to it. So you would, once you complete this form, you would uh, complete it, sign it, send it to the IRS via mail to the IRS office in which you would be required to file your income tax return. So you still send it by mail. And you would also be required to submit a completed signed form to your employer or to the person for whom the services are performed. So if if you there may be other people that need a copy of this form. So in the form instructions it says if the person who performs the services and the transferee of the property are not the same person, then the person who performs the services is also required to submit a copy to the transferee. And then you can only revoke an 83B election with the consent of the IRS. So once you make that 83B election, you can't go back and unring the bell unless you have specific written permission from the Internal Revenue Service. So if you do plan to file, you basically have 30 days after the date of the property transfer. So in this case, the grant date, you would have 30 days within the grant date. And according to the Internal Revenue Code, if the 30th day falls on a weekend or a legal holiday, then this election would be considered timely filed if it's postmarked by the next business day. So if your 30 days ends on a long weekend, you can file on the next business day. So let's take a look at this form. It's pretty straightforward. It's one page, and then there are 2 pages of instructions and other notes. So let's just say that John Doe is completing this because he so the property subject to this election. Basically, what you're talking about is whatever the description of the property is. So it could be 1,000 shares of Class A common stock of Corporation B. So let's just say that the property was transferred on 6/1/2025. Of course, we are recording this video significantly 30 days after. Let's make this more realistic. We're filming this in October, so October 10th or October 1st, 2025, he receives 1,000 shares. This is a grant of 1,000 shares, and he's making the taxable year for which this is being made, calendar year 2025, and the property is subject to certain restrictions. So let's say terms of the restricted stock agreement provide, this is legalese, it's not off the top of my head, it's straight from the form instructions. So 1,000 shares of Class A common stock of Corporation B will be forfeited if the person making the election ceases to provide services to Corporation B as an employee prior to, let's just say October 1st, 2028. So 3-year vesting. So let's say that the total fair market value of the property at the time, basically, let's just say that this is worth $100 a share. 1,000 shares, so it's $100,000. Now, he's willing to recognize $100,000 of income because he believes that by 2028 this will have gone up sixfold in price and he'd be recognizing $500,000 of income. Let's say that he actually paid $10 per item. So he actually paid $10, their options or whatever. So he actually had to pay $10,000 into this. So the total amount to include in gross income would be the difference. So in line 9, we're going to put in the information for the company. So in this case, basically, we're just putting in the name of the company, Corporation B, their taxpayer ID number or EIN, the address, city, state, zip code, and country if necessary. John Doe would print this out. He would sign it. Let's just say he signed it on 10/15/2025. And then he would have to look up the Form 1040 mailing instructions to figure out where to mail it. So, yeah. So if he's mailing it from Texas, then he would file his tax. He would be sending this completed form to the Department of Treasury in Austin, Texas. Put that on the envelope. Generally speaking, anytime that you're sending written correspondence to the IRS, I personally advocate taking the additional step to take it to the post office to make sure that you get proof of mailing, so that you have a timeline, you have some sort of document that can be reflected in an audit that shows that you did file this within the time frame. And then I would also make sure that you get like a delivery confirmation. That way it's considered timely filed if it's in the federal government's hands within that 30-day mark or postmark. So as long as you have proof that you had dropped it off at the post office by that 30th day, then this is considered a timely filed election. And again, you don't have to complete this form, just like you don't have to make it a Section 83B election. But if you're working for a company that's going gangbusters and you feel like it's better to pay some tax now than to pay a lot of tax down the road, you may choose to do that at that time. So this election doesn't necessarily give you rights to, sorry, I just noticed a typo here. It doesn't give you any more rights than you already had to those shares. So in this case, John Doe's literally paying or including $90,000 in income for these options, and he still has to wait 3 years before they actually vest. So these options could completely tank and become worthless if the company filed for bankruptcy. So there is a lot of risk to this. And before you get into this type of arrangement, you should really take a look at your prospects, talk to your tax advisor, make sure that this is a step in the right direction, particularly if you don't know whether or not you'll be working for that company in 3 years. You could be paying $90,000 on tax, and then for some unforeseen event, you end up walking away from these options. So take that as you will. Definitely make sure that you talk to your tax person before you make this election, because it is very hard to unwind. So that does it for this article or this video. I'll put links in the show notes to the article that we just created on this, and some other links to resources we've created on forms that might be relevant, things like stock option grants and how to report those. So that's all we have for IRS Form 15620. If you want to read the accompanying article, you can simply go to teachmepersonalfinance.com, type in In the search bar, IRS Form 15620, and the article should appear. So if you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have any questions or comments, or if there's a topic that you would like to see in an upcoming video, please hit us up in the comments section. Thank you very much and have a great day.